Well, good day there, Wealth Press traders, viewers, subscribers, and investors. It's time for the weekly wrap-up, and I'm joined, as usual, by Mr. Roger Scott. Roger, welcome.
Thanks for having me on, James.
You bet, Roger. Always a pleasure. Roger, what's going on in the Nasdaq recovery? Why don't we start there?
Well, unfortunately, the Nasdaq and the bond, the long bond, 2010, 2030, depending on which one you're looking at, they're all correlated about 99%. But the Nasdaq 100 it's locked into that bond, and that is the sector, the FAANG, the large cap tech. That's where the trouble lies. That's the sector that's completely losing its rhythm, so to speak. And it's looking horribly. I was just looking this morning, right before we got on, actually before the market opened, I was looking at the 10 major sectors, and usually you will see pairs. For example, basic material and industrial stocks. They're always next to each other, right? Utilities and consumer staples. They're always next to each other. But and lastly, technology and consumer discretionary. They're always next to each other. Sometimes tech is above, but sometimes consumer discretionary is above, but they're always next to each other. That's just how they roll. And right now, consumer discretionary is near the top or middle, and tech is like 4 or 5 spots down. Matter of fact, tech is second to utilities. Tech is between consumer staples and utilities. It's like a sandwich, and it never goes there. So you could tell that the rhythm of the market is completely not working the way it's used to. There's definitely, and we've talked about it a long time. Interest rate investors are very they're very cautious about how much income the tech sector will yield by the end of the year in comparison to interest rates, which are risk-free. And that's a major, major concern.
Right. And so how is that expected to impact, the general market sentiment outside of tech?
Well, that's a very good question, and I'll tell you why that's a very good question. See, if you look at these large cap tech stocks, you will find that the market capitalization in these for about, and I'm not exaggerating when I say 50 to 60% are the FAANG stocks like Facebook, Nvidia, Amazon, Google, Netflix. Those stocks, not all. Like Google's been doing well, but for the most part, those stocks have stopped going up. They started slacking off in May 2nd, if you want to be very specific. Okay. So they haven't been making all-time highs. Moreover, when I was looking at my 13F filings, which I do at the 20th of every end of every quarter, Apple's the biggest company in the world. Apple's everywhere. I mean, if you look at, for example, if I asked you a year ago, what's the biggest stock hedge funds would buy, you would say Apple. I mean, that's always there, right? It wasn't on my 13F filings, James. Apple was not even in the 5th spot, not even in the 10th spot. It wasn't there. No, I know. Right. That's what I'm saying. It wasn't there. It wasn't. Amazon was there. All the suspects were there that you expect to find at a glance. Apple was not there. Not for what they were holding and not for what they were buying, because they have to report both. So that's significant. And if we were going to talk about FAANG stocks, well, Apple's definitely a FAANG stock. So this is a problem spot right now. But let me get back to your question, because it's a very good question. So think about this for a minute. S&P 500, right? Well, how much of the Nasdaq 100 is in the S&P 500? Almost all of it. At least all the big stuff. At least, and remember, I just said a minute ago, remember, in US, we have capitalized weighted indexes. So the bigger the market cap, the more voting power it's got in the index. Well, you don't have to be an Einstein to figure out, you could look at it mathematically. Those FAANG stocks account for like 50, 60% of all the market cap of the Nasdaq. In other words, if I created a FAANG index and I put it next to the Nasdaq 100, their correlation, and I'm not kidding, would be like 85, 90%. So yes, every one of those large cap stocks is in the S&P 500. And yes, it has a big market cap in the S&P 500. So yes, it is influencing the overall market, not to a great degree, but it is influencing the overall market. The hard question is it broad or is it not? And I don't think it is, because volatility, VIX, is still now moving to the pre-COVID levels. So it is very concentrated, which is a good thing. That means the overall market is still humming along, but is very concerned about this one particular sector. But it's something we need to pay very close attention to because of the market cap that it has and the influence it has towards other stocks, if that makes sense.
Yeah, absolutely. So, Roger, taking a quick look at this chart, this is the Fed's yesterday's published financial outlook for as it stands right now. I find it interesting that here we have 10-year yields pushing well into over 170 basis point territory, and yet the Fed funds rate is projected out here in 2023 and the longer run as maxing out at 2.3 to 2.5, and yet we're at the rate we're going to be there before the end of this year.
I couldn't agree. That's what I was saying on Monday, that we're expecting to be at 2.3, 2.5% at the end of this year. That's exactly what I was saying, actually. That's what my models say. Exactly.
No,
and
but
can you spell inflation?
Yeah, exactly. But that's my point. It's like the Fed funds rate is showing as, 2022 exit 0.1, 2023 exit 0.1, longer run 2.5. Yet the 10-year rate is already pressing through those levels, meaning that the Fed fund rate is not necessarily going to be the benchmark going forward. It's going to be the 10-year. And that's got to have a huge impact on everything from commodities to tech stocks to fixed income.
I couldn't agree with you more. I could not agree with you more. But here's the rainbow at the end of the tunnel, okay, if you will. The rainbow is most of the stocks that I'm looking at right now, and as far as the broad market, the S&P is pricing that in. The S&P is actually pricing in about 2.5% interest yield at the end of the year. Because, and here's how I do this. You and I had this conversation, maybe it was premature. We had this conversation about a month ago, or maybe 3 weeks ago. I lose track of time. But here was the conversation. Let me remind you of the conversation. I did studies going back to 1980, and I looked at the yield at the end of the year, earnings per share yield from the S&P, trailing 12 months, compared to the 10-year. And I found that on average, over the last 50 years, the yield on the EPS for the S&P 500 is about one handle or 100 basis points higher than the yield on the Treasury, okay? So what I did was I looked at the estimates for what we were looking at the end of the year for the 10-year, and I came up with 2.5, which is what we're talking about right now, right? End of the year. And then I looked at the trailing 12 months EPS yield on the S&P 500 and found it to be between 3.5 and 4. So my point is the S&P is already pricing that into its value, and which is why it's not really going down except for the influence that those tech stocks are having in it.
Yeah.
So the good news is the broad market is pricing in inflation. And the Fed yesterday for the first time, today's Friday. Was it yesterday or the day before? I lose track of days. The Fed said they finally acknowledged that we're seeing inflation. They used the word inflation. They acknowledged it, James, finally.
Yeah, that's right.
They're not really addressing it, but they acknowledged it.
Right. So this is the interesting thing, though, Roger, that despite all of the sort of needles in the red zone of all these indicators, the VIX has sort of descended to where it's like, there's no problems here. Everything is coming up roses, despite, there's cracks forming on every sort of surface of this whole financial egg here. And I don't know, where do you see this thing going longer term? And when I say longer term, I'm talking within 2021. What should be our, where should we be orienting ourselves defensively?
Well, I agree with you and I disagree with you. In terms of, and I mean, this is why we all trade. Everybody's got different opinions. My opinion is this. I do agree with you that there's a lot of cracks in the foundation. Jobless claims are still crap. Industrial production was crap. Retail sales was crap. And if people think this $1,400 check is going to get us out of this rut, let me sell you a couple of bridges. Let's be real here, okay? $1,400, is that going to be our solution to our problems in life? And most people are going to end up spending that and blowing it on the summer vacation anyways. That's what people do. That's just how people work. But here's the thing. We need employment. We need the economy to restart again. And that's where the trouble is. So there are cracks in the foundation, but I think the momentum and the liquidity that we're seeing in the market and that we're providing the market right now is over, what's the word I want to use? It's overruling the concern that we're seeing with this cracks in the economy. The upside is too strong compared to the downside, if you will. And I think we're going to see a lot of momentum into 2021 continue, but it's going to be bumpier than 2020. I don't think we're going to see one correction and this huge recovery that pretty much lasts 10 months. I think we're going to see a few bumps in the road. I think the Nasdaq is not done yet. I think it's going to hit the 200-day moving average. I think that it needs a washout. Momentum levels are still in the 70th percentile after going all the way to the 90th percentile. We need to have a clear washout. The weak hands need the weak stocks need to show their hand. And I think that's going to happen throughout earnings, which aren't due yet. The good part is large cap techs report first or second after bank stocks. So we're not going to be waiting that long. But I think here's where I think is going to the interesting part's going to happen. If we have earnings, and if earnings looking forward, James, can prove that the earnings yield on the Nasdaq stocks can outperform that cap, that inflationary pressure that we're seeing in the bond market, then I think they'll rally again. But I'm not so sure we're going to see that. I'm not sure that's going to happen. So I think we're going to be hovering around these levels in tech for quite some time. And when I say quite some time, remember, I'm short term. I'm talking maybe another quarter, maybe another 4 months. Ultimately, techs will get out of this. What you are seeing with tech is very much like what you saw with small caps before the rally that started in November, December, late October, November, December of 2020. Ultimately, the tech will catch up and supersede, but we need to see the sector rotation. We need to see where earnings stand. We need to see how the economy flows. We need to see how the bond market does. We need to see if the economy can stand on its own. If the economy can stand on its own, and if earnings on tech will outperform estimates, there's a good chance we'll get out of this in one piece. If not, then tech is going to hit the 200-day moving average. And yes, that's going to cause a big stress to the S&P 500 because of what we discussed. There's a huge market cap of the FAANG stocks in the S&P 500.
Are there any dividend stocks that you might be able to talk about that might be safer havens than others at this point?
James, you've read my mind. I was just about to go into that. So yes, if you take the tech stocks away, there are amazing opportunities, but investors have to be flexible. They have to be nimble. They have to look other places. For instance, I have been finding really good stocks in the industrial, financial, even energy right now. We have to go with the low-hanging fruits. The low-hanging fruits right now are energy, financial, industrial, and basic materials. So, for example, and yes, dividend stocks, not tech stock, resource stocks, industrial stocks. You know, industrial stocks go up with higher interest rates, just so everybody knows. That's just how it works, because industrial stocks go up when the economy picks up, and interest rates go up when the economy picks up. But let me give you a couple of really good stocks that I'm liking right now. I'm right now looking at value. I'm right now looking at stocks that have intrinsic value, that have dividend yield, companies that are completely opposite of the large cap tech sphere. So to give you an example, one stock I'm looking at is Prudential Financial, PRU, Fortune 500 stock, a stock that a lot of large hedge funds have in their portfolio. The dividend yield is almost 5% on this stock. Company is only 140 years old. You're not going to get hurt, and the stock is doing really well right now.
I'd say so. As a 140-year-old company, how long has it been paying a 5% dividend?
Oh, that I'm not sure, but it's been paying a dividend for quite some time. This is a high dividend stock. This is not a stock that reinvents the wheel, but that's what investors are moving right now. Remember, when investors get cautious with the stock market, they gravitate towards safety. Okay, well, maybe this is not as safe as the bond market, but I think you and I would both agree that Prudential is not Amazon, you know what I'm saying, or Tesla. You know, you're not going to go bankrupt buying Amazon. Excuse me, Prudential. I've never heard anybody says, I went bankrupt, I bought Prudential stock. I mean, it's just not that kind of company. They've got plenty of cash. It's a 5-star stock, but it's rallying right now. Is there any way we can pull it up on your screen?
This is the chart, and obviously it has been doing very well over the last, since the beginning of 2021. It's added just about 25%. So not only is it a great dividend play, it's a great speculative play as well.
And notice it started really moving when tech stocks started really dropping and interest rates started going higher, right? Next one is EOG Resources, ticker symbol EOG. And I know you're familiar with this company because this is your neck of the woods, but it's a blue chip energy stock. Okay, so it's the largest independent crude oil natural gas company in the U.S. and they have reserves in Trinidad, U.S., China. They have 57% free cash flow payout ratio. 57%, James. That's crazy for this sector. They've got a 1-year return of 108%. They've got a dividend yield, not a huge, but dividend yield of 2.05%. And I'm looking at $100 a share for this stock.
Now, when you say 108% full year return, is that including the dividend?
Yes, I believe so. The stock has gone up 108.88% over the last year. Wow. No, I'm talking about just share price, just return on share price.
Wow. So add 2.5% to that, and there you go. It's a
real. But I love the 57% free cash flow payout rate and I mean, it was beaten down in 2020, as you know. If we go a little long term, you'll see the stock is just coming back out. And again, this is where the money is. Yeah, there we go. This is where the money is. The stock has plenty of upside to go. If you go further, you'll see that it's just now breaking above that level, where the breakdown level. So this stock's got a lot of opportunity ahead of us right now.
Sure. Well, if it was to return to March 2020 levels before the onset of the pandemic, which is where one would expect, it's still got at least $15, $20 to add. Precisely.
Oh. And then finally, this is a fun one. And again, this is not a stock none of these stocks are sexy. You know what I'm saying? Sure. So the next one is Snap-on. It's a tool company. They manufacture tools, equipment, diagnostics, repair equipment, and system solutions for all critical tasks. They yield 2.2%.
Wow.
And their free cash payout is 28%, which is really good. The stock is making all-time highs.
Yeah.
Again, industrial, basic material, 4 quarters positive earnings estimates, 2 positive earnings surprises, 2 quarters. I've got a price target of $250 on this stock. And the annual dividend yield rate is almost $5, $4.92.
Fantastic. Wow.
1 year return, 103%. And I wouldn't be surprised, honestly, to see it soar to 300, but my short-term target is $250 a share.
Wow, fantastic.
So I really like these stocks, and I think these are the type of boring companies you want to be looking at right now, but that's a good thing. That means economy's heating up, and all 3 stocks are sensitive and do well in a higher interest rate environment.
Sure, and the dividend is certainly adds juice to the return, doesn't it?
Definitely. I mean, again, this is not Tesla, it's not Amazon, but this is where you want to be right now.
Wow, fantastic. So then what is this, what's the effect on commodities from where you sit?
Well, James, I was looking at the CRB index last night. Funny that you mentioned it. I don't know the ticker for the CRB index, but if you look at a long-term chart, for those of you who don't know what the CRB index is, for the stock market, we use the S&P 500 or the Dow Jones. For commodities, we use the CRB index. The CRB index tracks all the commodities in one easy-to-use index, and it's the CRB index. it's right now, the last year, it's gone up and it's making a 5-year, it's at the highest level right now we've seen since September of 2015. In the 10-year, this is the high. We're messing with a 10-year high right now on the CRB.
Well, there we are. It is right here. And wow, look at that.
Yeah,
Since
that's
May,
what I'm looking at. That's what I'm looking at right now. Right.
From 120 to 198.87. That's a great.
So if you want to know how commodities are doing, well, all you have to do is look at the CRB index.
Yeah. Excellent.
And so you know how the commodity market's doing.
Crude oil. Well, crude oil's 50. Well, I guess that's you. No, that would be WTI, 59, just under $60 a barrel. Brent at 62, a little higher is to be expected. Natural gas is starting to make $250 per TCF. I'm assuming that is. Gold 1734. This is a great site.
CRB. So I look at the CRB index all the time, although I have problems finding it now. So I just go to the internet and I just find it. But so if you can find the ticker for this, I would be grateful. But CRB index is it's just like, it's like looking at commodities on a one-shot deal. And again, this used to be very popular when I was but then so were the OEX options. But I've been doing this for a long time now.
Wow, no doubt. Well, it's funny that none of my normal charting platforms, you punch in CRBC under indices and it doesn't bring up anything. So
I don't know why. Back in the day they had CRB index calendars and everything was CRB. I don't know why they don't do that anymore. But
that would imply that there's nowhere you can buy the CRB index.
Futures. I think you could still do it on the futures market. But again, I've been away from the futures market for over a decade now. Everything on futures you could do now with ETFs. But the point is, that's a nice, easy, simple way to kind of have a one shot at commodities.
Yeah. Okay. Well, that's great, Roger. Let's leave it there for now. That's a great wrap up. As usual, always a pleasure. Very informative. We'll talk to you on Monday. Have a fantastic weekend.
This was a great session, James. Have a great weekend. Bye.